Hello again and welcome. This is Robert Schein, Managing Director, Partner of Blanke, Schein Wealth Management. Thanks for tuning in to our Tuesday Market Insights and Observations. And today we're going to go round out sort of what the markets are paying attention to. We are here at Blanke, Schein Wealth Management, how we're navigating through the next few weeks between now and year end. It's amazing. This is our last broadcast of November, and the year end is rapidly approaching. So we are taking the time to rebalance portfolios, square up any tax loss selling, take advantage of sort of covering any gains, or even harvesting losses to make it tax neutral. Again, if you're a client of ours and you've had some real estate transaction where you've had a gain outside of us, or from a capital gain standpoint, or even an investment portfolio, or any other sort of capital gain, let us know, because we want to make everything as tax neutral between now and year end as possible for you in your overall portfolio. So reach out to us directly. That being said, let's talk about the markets today and the last 48 hours of the market cycle. It's all about COVID once again in China. You may have seen the news, you may have seen sort of some of the reports that are coming out, but it's the zero COVID policy and just working its way through China right now. The biggest fear in the lockdown is simply that if COVID really were to break out on a larger scale, their medical system, their hospitals can't support, and that's why they are opting for this zero COVID strategy. That being said, again, it's supply chain disruption, and markets are then interpreting that to sort of the fits and starts of what we've experienced here and globally over the last 2 to almost 3 years now. That's spooking the markets and is something to pay attention to. We are here at Blanke Schein Wealth Management. And the next thing is again, markets sold off last couple of days in anticipation of the Federal Reserve tomorrow. Jerome Powell speaks, and I think the markets would expect nothing more than just a hawkish tone. He has to remain hawkish. However, at the same time, there is some indication that the Federal Reserve policies, their hawkish tone, is really impacting the overall economy, specifically in housing. Housing slowdown continues. Home prices are declining and rents are declining if you look at sort of the leading indicators. And that's one of the things that the Federal Reserve is looking at, sort of wages as well as rents. And as those come down, because those are 5 years down the road, anchoring sort of inflation expectations lower as we can see those come down. You're seeing big tech and a few other sort of sectors around the S&P 500 start laying off or at least hiring. And that's another aspect that the Federal Reserve is looking for, is that slackening or loosening in the labor market, therefore inflationary pressures on a sort of small business or a business owner's standpoint. It's sort of, there's a sort of a balance. We're also seeing that balance sort of occur in the supply and demand, and also the asking prices are coming down in real estate. That being said, we're also seeing PPI inflation down, which is good. Obviously, there's China lockdown, but small business expectations, there's a lot of small business owners that aren't too confident, and CEOs aren't too confident in the future moving forward, because there's a lot of still uncertainty as we move into 2023, and we're going to see how this plays out. We're positioning accordingly. Again, a lot of short-term fixed income, a lot of short-term treasuries, cash, and we're just sitting tight. That what we own is quality that also pays, whether it's bonds or income producing dividends, and we're just collecting those, and we're reinvesting and averaging into quality sort of companies that we know will not only make it through, let's say, a potential recession in 23, but also become stronger as a result, because remember, competition sort of disappears. So the bigger companies, think the S&P 500, get bigger and stronger as a result. So you want solid balance sheets, solid earnings in terms of, and then solid management teams. Again, management teams can get through quite a lot, and that's why we have confidence in the future of the companies that we own for our clients, simply because we saw them get through when the world was shut down for about a half a year, and corporations were still able to make money when we were all at home. And they'll make money through a recession because they have such a tight control on their balance sheet. Now, let's talk about the balance sheets and how the scorecard played out for the third quarter. Third quarter earnings, there's sort of the four matrix that we look at from the scorecard overall: the growth potential expectations, what it was on the quarter, but year over year, the guidance, how many companies actually guided either positive or negatively moving forward, and the valuation. Are we overvalued? With the S&P 500, is there room to move down on the markets, or where are we in the valuation? Those are the four things we're constantly paying attention to when we see earnings scorecard. But 94% of earnings have been, or companies in the S&P 500 have reported earnings, and over 70%, 71% have exceeded or even surprised the upside. Again, that's historically in line with the average. So that was sort of a good thing, but we also want to see what the growth rate. Third quarter growth rate is 2.2% in earnings growth. A lot of that could be attributed to your real estate, even though that's slowing, but year over year real estate has gone up, as well as earnings coming from energy. Energy was up 135% attribution analysis in the earnings growth, whether it was the 9.2% year over year for the S&P or the 2.2 for the quarter. So earnings are still coming in from energy, but we expect anticipation moving forward. Let's say real estate sector, which was hot last year, is going to drop off. So that's going to pull down and weigh down on earnings. I'm going to show a chart right now, and this is sort of where the valuation is on the S&P 500. And that being said, the S&P 500 is really what the market is trying to discover. It's a price discovery right now. And what you're seeing is the S&P change in forward 12-month earnings per share and the price. And so you have the blue line as well as the black line, and essentially they're now parity with each other. They're one for one in line, but the forward PE on the S&P is just showing that there's earnings expectations of about $230 per share. We started $240 earlier this year, and that has come down. There are analysts that say it goes all the way down to 200. It could go be 220 by the time we're done, meaning that companies will continue to guide lower. Earnings will continue to decline moving forward because of recession, because consumers are tightening their belt. And if that happens, the valuation at 17 multiple, forward multiple, markets could trade level. Now, lower a little bit. Now, the 17.2% or 17.2 times forward earnings is showing just that. That's below the historical average of the 5-year, and then also in line with the 10-year in terms of pricing where the market valuations are. So if earnings stay the same, valuations are appropriate. If earnings start deteriorating a little bit from different sectors, some sectors will be better than others, and that's why we diversify. We will actually see markets sort of translate into forward pricing. Well, let's talk about the guidance. Well, about 10%, 55 companies have guided negatively or lower in their outlook or their view of the fourth quarter of this year. And that's not terrible. Usually it's around 5 to 7%. So there's diversification in the economy, diversification in the portfolio that really guides us through this. Now, is there a Santa Claus rally on the way? There's a couple moving averages that we have to pay attention to, which is the 200-day moving average. What could change that? It's on the S&P 500, and it's above the 4,000 level. So we could see markets try and test that. If they break through, we could see Santa Claus rally. If they fall back, we could say more buying opportunity ahead between now and year end. We're going to pay attention to that. What could move that? Again, it's tomorrow's Fed meeting. So we'll pay close attention to that. And my final comments right now is go USA. USA Men's World Cup is going to play Iran. By the time you see this later today, we will have the outcome. But let's see. Hopefully the USA Men's soccer team can get it done and advance in the World Cup, which is a very special thing every 4 years. So that's our update for today. We appreciate it. And that's our last market insights and observations for November. We'll see you again. Take care. Bye-bye.